Bitcoin's core monetary policy hasn't fundamentally changed in over a decade. The 21 million coin supply is the same. The block schedule is the same. So why does it suddenly feel like you're trading a big tech stock? And why did its price recently seem to move more with the Nasdaq than with its own halving cycles, only to then completely break away? The answer is simple. Bitcoin didn't change. Its new owners did. Wall Street has arrived. And they're not just playing the game, they're changing the entire stadium. In this video, we're breaking down how the flood of institutional money through ETFs has altered Bitcoin's behavior, how this new ownership is making it move in surprising new ways, and what it all means for your portfolio. To understand just how radical this shift is, we have to remember the old Bitcoin. For most of its life, Bitcoin was the ultimate outsider. It was a world of retail investors, cypherpunks, and true believers. Its rhythm was dictated by its own internal logic. 4-year halving cycles that squeezed supply, wild swings driven by forum sentiment, and a narrative that was almost mythological. It was a chaotic, decentralized, and often isolated ecosystem. You bought it on specialized exchanges. You fretted about self-custody with hardware wallets. And you tried to explain to your family why you were investing in magic internet money. While its correlation to markets like the S&P 500 wasn't always zero, there were long stretches where it was close, and it often spiked during major macro events. It largely marched to the beat of its own drum. But that isolation is over. The fortress walls of traditional finance have been breached. And while the charge was led by pioneers like MicroStrategy and overseas ETFs, the instrument that blew the gates wide open was the US spot Bitcoin ETF. The approval of spot Bitcoin ETFs in the United States wasn't just another headline. It was the financial equivalent of a Trojan horse. It rolled into the city of Bitcoin looking like a gift, a way to legitimize the asset and make it accessible. And it worked. But inside that horse was an army of institutional capital that would change the landscape forever. So what's an ETF? Simply put, it's a stock you buy from a regular brokerage account like Fidelity or Charles Schwab that does nothing but track Bitcoin's price. For the first time, anyone with a retirement account could get Bitcoin exposure without the complexity of crypto exchanges or seed phrases. And Wall Street rushed in. The numbers are staggering. Since their launch, US spot Bitcoin ETFs have attracted cumulative net inflows of around $57.9 billion. The total assets held in these ETFs peaked at over $169 billion in October before a recent market correction. BlackRock, the world's largest asset manager, saw its IBIT Bitcoin ETF become one of the fastest growing ETFs in history, accumulating over $70 billion in assets under management by December 2025. This isn't just a new product, it's a fire hose of institutional money pointed directly at an asset with a fixed supply. This shift was championed by some of finance's biggest names who once dismissed Bitcoin but now praise it as a legitimate asset class. The change was helped by growing regulatory clarity as frameworks like Europe's MiCA were implemented and the US made progress on stablecoin legislation with the Genius Act in July 2025. Now here is the most important and surprising consequence of this invasion. For a while, it seemed Bitcoin was being absorbed into the great financial machine. The new owners, pension funds, asset managers, corporate treasuries, don't see Bitcoin as a revolution. They see it as a risk asset. When they build portfolios, Bitcoin gets placed in the same bucket as high-growth tech. When their risk models flash red, they sell everything in that bucket together. For much of 2025, the data seemed to prove this out, with Bitcoin's correlation to the S&P 500 averaging around 0.5. But then, things got weird. In late 2025, just as everyone thought they had the pattern figured out, the correlation broke. As the S&P 500 and Nasdaq rallied, Bitcoin fell, with its correlation to stocks dropping to yearly lows, even turning negative. We saw this clearly during the sharp correction in the fourth quarter. Bitcoin's price fell over 30% from a peak of around $126,000, dropping below $90,000. Was this because of a crypto-specific event? No. It was driven by broad macroeconomic fears and a sell-off in specific tech sectors that spilled into crypto. On some days in November, ETFs saw huge outflows, with one day recording around $900 million in withdrawals, amplifying the downward pressure. When the market sneezes, Bitcoin might catch a cold, or it might just ignore it completely. The old dream of Bitcoin as an uncorrelated hedge isn't dead, but its relationship with the market has become incredibly complex and unpredictable. So, what does this all mean for you? If you're feeling a bit of whiplash trying to navigate this new world, take a second and hit that subscribe button, because understanding these shifting dynamics is the key to surviving and thriving. If you're an investor, the rulebook has been rewritten. The old mantra of just hodl and wait for the halving, while still important, is no longer the whole story. The new reality is that Bitcoin is a macro asset, but with a mind of its own. Its price is intertwined with Federal Reserve decisions and stock market health, yet it can suddenly diverge. You can't just watch on-chain data anymore. You have to watch the global economy and be prepared for Bitcoin to break the rules. This creates a dual-edged sword. On one hand, during risk-on periods, these ETFs provide a powerful structural wave of buying. Constant inflows from retirement funds and portfolio allocations can create a demand floor that didn't exist before. This could potentially dampen the gut-wrenching 80% bear markets of the past, though that is far from guaranteed. But the flip side is what we saw in late 2025. During the liquidity crunch, institutions may sell Bitcoin alongside other risk assets, leading to sharp, correlated drops. The very ETFs that provide a steady flow of buying on the way up can become a torrent of forced selling on the way down. So how do you adapt? First, your analysis has to expand. You're not just a crypto investor, you're a macro investor now. Understanding what drives institutional capital is crucial. Second, your portfolio strategy needs to reflect this. The idea of a small 1 to 5% allocation is becoming a more common discussion in wealth management circles. Bitcoin's role is shifting from a purely speculative bet to a strategic holding for diversification, but one whose relationship with the rest of the market can change on a dime. Let's go back to where we started. Bitcoin's code is unchanged. Its decentralized network keeps producing blocks every 10 minutes. Its supply is still capped at 21 million. Bitcoin itself hasn't changed, but the game being played on top of it is completely different. Wall Street didn't break Bitcoin, but they shattered its isolation. They brought their capital, their algorithms, and their rules. They've turned it from a fringe asset into an institutional-grade component of the financial system. The result is a more liquid, but also a more complex and unpredictable market than ever before. And this leads to the ultimate question, one that goes beyond the charts. Wall Street brought its money, but in doing so, did it steal Bitcoin's soul? Is this new, more complicated Bitcoin that sometimes moves with the S&P 500 and sometimes moves against it still the revolution it was meant to be? Let me know what you think in the comments below. And if you want to keep making sense of this new financial world, make sure you like this video and subscribe for more. Thanks for watching.